So, let's talk about the language that every single business on the planet speaks. I'm talking about accounting. Now, I know what you might be thinking. Math, numbers, spreadsheets, but trust me, don't think of it like that. Think of it as a storybook. Every company has a story to tell, and financial statements, that's how we learn to read it.
Have you ever looked at a massive company like Apple and just wondered, how does that actually work? How do you peek under the hood and check its financial health or see how it's really performing? Well, that's exactly what we're going to do right now. We're going to break it all down.
Okay, so to get any of this, we have to start with the one single rule that underpins everything in financial accounting. Seriously, everything. You can think of it as our true north, the compass that guides us through all of it. And here it is. Assets equals liabilities plus equity. It's actually beautiful in its simplicity. On one side of the scale, you have everything the company owns, and on the other side, you have how they paid for it, what the company owes to others, like banks, plus what's left over for the owners. And here's the magic trick. Both sides must always balance perfectly.
To make this less abstract, let's just look at Apple. In 2024, Apple had almost $365 billion in assets. That's the what it owns part. We're talking cash, inventory, their shiny Apple stores, you name it. A huge pile of resources.
And here's how the other side of the scale looks. That $365 billion in assets is balanced by about $308 billion in what it owes to others, that's its liabilities, and about $57 billion in what belongs to its owners, the shareholders. It adds up, see? It always balances. That's the equation, right there in the real world. So, this whole balancing act gets laid out on a document called the balance sheet. The absolute best way to think about it is as a financial snapshot. It's like taking a picture of the company at one specific moment in time and saying, okay, right now, this is what we own, this is what we owe, and this is what's left.
So what does it take to be an asset? Well, it's not just about stuff the company has. The key here is that it's a resource that's expected to provide future economic benefits. It's something that's going to help the company make money down the road.
And this can be a whole bunch of different things. You've got the easy ones, like cash. Then you've got inventory, all the iPhones waiting to be sold. But it also includes money that customers haven't paid you yet. That's called accounts receivable. And it can even be things you can't touch, like a valuable patent. That's an asset too.
Okay, now for the other side of that coin, liabilities. These are pretty straightforward. They're the company's debts and obligations to everyone else. In simple terms, it's all the money the company owes. This can be money you owe your suppliers, that's accounts payable, or just a regular old bank loan. But it also includes something kind of interesting called deferred revenue. So picture this, you buy a one-year subscription to a streaming service. You've paid them, but they still owe you a year of service. For them, that's a liability until they've delivered all those months of shows. And that brings us to the last piece of the puzzle, equity. The easiest way to think about it is like this. If a company sold every single thing it owned and then used all that cash to pay off every single one of its debts, whatever was left over, that's equity. That's the owner's slice of the pie.
Okay, so the balance sheet is a snapshot in time. But that doesn't really tell us how the company is doing. For that, we need the income statement. If the balance sheet is a photo, the income statement is a video. It shows you the action over a period of time, like a quarter or a whole year. It's basically the company's report card.
And here's how that report card works. You start at the top with revenues, which is just total sales. Then you subtract the direct costs of what you sold, and that gives you gross profit. From there, you subtract all the other business costs, like marketing and salaries, to get operating income. Finally, after you pay the bank some interest and the government some taxes, what's left is the famous bottom line, net income.
But here is a super important rule you have to understand. It's called the accrual principle. It says that a company records revenue when it earns the money, not necessarily when the cash hits its bank account. And on the flip side, it records expenses when it uses a service, not when it pays the bill. This gives a way more honest look at how the business is actually doing.
And this is where it all clicks together. That net income, the bottom line from the income statement, doesn't just disappear. It flows right over to the balance sheet. The profits the company decides to keep are called retained earnings, and they get added to the equity section. So the video of performance directly changes the snapshot of financial position. Pretty cool, right?
Now, that idea of earning revenue is so critical that there's a whole set of rules just for that. It sounds simple, but figuring out the exact moment a company is allowed to count its money is one of the trickiest and most important parts of accounting. So, accountants have this 5-step process they follow.
They look at the contract, they figure out all the different things the company promised to deliver, they set the price, and then, and this is the big one, they only get to count the revenue as they actually fulfill each of those promises.
Let's make this really clear with 2 examples. Say a gym sells you a 1-year membership for $1,000 up front. They can't just book all that cash as revenue on day 1. Nope. They have to earn it 1 month at a time, over the whole year. Or think about Apple. They sell a Mac for $2,000, and that includes a 3-year warranty. They can recognize the money for the Mac right away, but the part of the price for the warranty, they have to spread that out over the whole 3 years. It's all about matching the revenue to when the value is delivered.
Hey, remember when we were talking about assets a minute ago? One of them was accounts receivable. That's what happens when you make a sale on credit. So let's zoom in on that, because managing the money your customers owe you is a really big deal.
So, accounts receivable is basically a bunch of IOUs from your customers. It's an asset because it's cash you expect to get in the future. But, and this is a big but, there's always a risk. What if some of those customers never pay up? You can't just pretend you're going to collect every single dollar.
So how do companies deal with that? They use a nifty tool called an aging analysis, which is what you're looking at here. They group all their IOUs by how long they've been waiting to get paid. And you can see a clear pattern. The older an invoice gets, the higher the chance it'll never get paid. So based on this, the company estimates that out of the $100,000 it's owed, it'll probably lose about $2,900. For an investor, watching this is super important. If those old unpaid bills start piling up, that could be a huge red flag.
Okay, this brings us to one last really powerful idea. The value you calculate from the balance sheet, the book value, is often wildly different from the company's value on the stock market, its market value. See, book value is all about the past. It's based on accounting rules and what things cost when you bought them. But market value? That's all about the future. It's what investors think the company is going to be worth based on its brand, its cool new ideas, and its potential.
Let's bring it back to Apple one last time for a reality check. Its market value is about 59 times bigger than its accounting book value. 59. That's just staggering. And it proves that these financial statements, as important as they are only telling us part of the story.
Which leaves us with a really fascinating question to think about. If the accounting books only capture a tiny fraction of a company like Apple's real worth, where is all that other value hiding? You know, the value of the brand, of customer loyalty, of pure innovation. And that's the real power of learning this language. It doesn't just give you answers, it gives you the tools to start asking much, much better questions.